I've worked with Elisa on a few apartment investments, and I'm super excited to be on here today and talk to you all. Basically, a year and a half ago, I got interested in infinite banking because I read this book called Money, Wealth, and Life Insurance: How the Wealthy Turbocharge Their Savings. That's the name of the book, kind of like a long title, but I mean, an immense amount of knowledge. Just to that book, I don't know, it was like an aha moment for me. I'm like, why didn't somebody tell me about this before? Because all I had heard until then about insurance was Dave Ramsey saying buy term and invest the difference. And that was the first time I really kind of saw it. It was an eye-opening experience, or, reading the book was an eye-opening kind of aha moment for me, because I suddenly realized, oh my God, I could have used this all this time. And, of course, it's never too late. And I started reading so much about it because I really wanted to be educated before I did that. And the process ended up getting my license and saying, hey, I could do this for myself. And also saw that, a lot of my investors would really benefit from this because they had money sitting on the sidelines, which wasn't getting into deals while it was waiting for deals. And I'm like, this would be a perfect place to park your money while it's waiting for a deal, and then leverage and take money from there when you're ready for a deal. And not just from an investment standpoint, but I also see this as a powerful way to invest for college savings or save for your retirement, among other things, because just the tax-free vehicle that the insurance policy it can be when it's set up the right way gives you a powerful way to grow your money. So today I'm going to talk about how to become your own banker. And the idea is that you leverage, sorry, let me go to the next slide. It's basically a way of creating a safe, high yield bank account that you can use for investments, college savings, retirements, and pretty much anything you really want to do with it. It's basically, I think you have to kind of walk away. The one thing I had to do over time is to not look at it as an insurance policy and instead look at it as a savings account. So it's a savings account designed, underlying is just insurance is the side benefit of it, right? Not the main benefit that we're looking for. And of course, having insurance is a great benefit because now you're thinking about generational wealth and not just, creating wealth for you for this generation. So definitely come to the right place to learn about this. And I'm excited to be here. A little bit about me. I'm a real estate investor like Elisa. I started in single family homes, did that for a while, and then figured out, okay, there's got to be something better I can do to scale up because I just didn't want to buy any more single family homes. I got into real estate as a syndicate after almost 20 years as a technology professional. I worked for IBM at a company called Atlassian. A lot of you who are in the tech space will probably know about Atlassian. I am also an investment-focused realtor, primarily working in the Austin metropolitan area, and also a life insurance broker focused on infinite banking. I can do other kinds of policies, but I just think that infinite banking policies are really powerful and a great way for you to save money. I have a master's in computer science from A&M. Again, just a little bit of overview about me, rental portfolio, multifamily investments. I have a group called Purely Passive, and I do a lot of education webinars like Elisa, and we're actually talking about how we can combine forces at some point, and I'll be excited to do that. I also have a 15-year-old daughter and 2 small puppies. So before I jump into talking about life insurance, I want to talk about the necessity for this, because for me, myself, I suddenly had this, when I started learning about insurance and I learned more about how it can help me invest better, I started looking at it. This picture was, again, another aha moment for me, where I realized that in the past, a lot of us have done is the speculation which we call the tier 4. If you're familiar with the Maslow's hierarchy of needs, this sort of mimics that in the financial world, where the tier 1, 2, 3, 4 represent higher risk as they go along, and lower amount of control as they go along as well. So if you think about tier 4 as a stock market, you really are taking a lot of risk. And of course, your returns are high, but you also have no control over which direction the market's headed. And as you come down to the lower tiers, you create more of that stability and control and low risk in the lower tiers. So if you are, let's say, single family investor, you're basically sitting in the tier 2 where you're directly investing in something, you have direct control over it. And so you can manage those risks better. If you're sitting in tier 3, you're doing syndications. None of these tiers are good or bad by themselves, but looking at the wealthy gives us a good indication of how we should invest in terms of where in the tiers we should be or how much we should put in each tier. Right? So when I started investing, I started with tier 4, and I see that almost 80% of the investors I talk to today are in tier 4. 80 to 90% of their wealth is in the stock market, whether it's through retirement accounts, whether it's through direct cash investments, and only maybe a handful of them have like single family homes or some other investments which are in the 2 and 3 tier. And I find that a lot of people are underprotected when it comes to tier 1 because they look at insurance as this extra cost, right? They're not looking at insurance as a way to save because they don't just understand this concept. Also, if they might have solid savings, let's say they have their business reserves, their personal reserves, all in tier 1, but it's sitting in a savings account earning 0.75% or a percentage, which is not even keeping up with the inflation. So foundationally, what I find is when the wealthy invest, they have a lot of investments in 1 and 2. They even have 3 and 4, but they're concentrating, they are basically building that foundation of that pyramid really strong. Whereas most of us, like middle class, we end up in tier 3s, maybe 2, 3, and 4, and we forget to focus on the 1. And whole life is foundation is really a part of that tier 1 foundation where it's a safe investment. It's not an investment, actually, it's a safe savings. It allows you to grow your money at a very constant rate, and it's tax-free, most importantly. So it's really important. I always stress this with my investors saying, hey, think about this pyramid and you need to construct a really strong base here.
Yeah, that's very important, Kavitha, because I think it was a few of our listeners over summer involved in tier 2 and 3 investments, and a few of them even tier 4. So it's kind of good to think about this because oftentimes people are like, oh, I'm investing in whole life insurance now, I'm all good. It's like, okay, that's not really a wealth generating vehicle, but rather it's a somewhere that's good to park money. And then from there, you can have a multitude strategy combined with all this to kind of yield a few extra points over there to boost your investment.
Absolutely.
And actually having a better protection. That's kind of like where the points over there too. Yeah.
Right. Yeah. So you kind of want to use that as a base and then use that to invest in the higher tiers, right? Like generate higher returns on your money using the higher tiers. And we'll talk about that through the presentation. So this is just another way of looking at the same thing. I just wanted to point it out, like I mentioned, single family homes. Here you have, maybe you're investing in a mobile home park or your apartment syndications, and there you have the stock market. And the most important investment, I believe, is an investment in yourself. And that's also a part of the tier 2 investment, where you're directly investing in something that you can control. So this is just another way of looking at the same thing, the foundation and where high cash value whole life insurance belongs is that tier 1. Again, the same little bit emphasis on breaking it down into different kinds of investments, but pretty much the same thing. So here I want to talk about, let's say, you're retiring or you need 80K every year to live on, and you can create over your lifetime 3 buckets of money, the way I look at it. One is the pre-tax dollars. So you have a 401k or you have an IRA where you haven't paid taxes and you've socked money away, which is great. You want to do that, especially if your employer is matching. It makes sense to do that because you're collecting some extra dollars from your employer. A lot of people do it. But the problem with this pre-tax dollars is that I have talked to a lot of investors and they feel somehow that their tax bracket is going to be lower when they retire. I hope it is, especially if you're a real estate professional, that's a real possibility, right? Because you can use the depreciation to get yourself into the lower tax bracket. But if you're not, then you have no guarantee that the taxes are going to be lower in future than now, because this is really Congress's playground. Anything can happen over a period of time, and has happened in the last 30 years. Taxes have gone up, taxes have gone down. So you really have no control over where it will be in the future, or what your tax bracket will be. Another reason not to put too much money into the pre-tax bracket is because you don't know, you're assuming that you need less money than now to live on, but the assumption might not necessarily be true, because you still want to maintain a quality of life, right? A good quality of life. And the amount of money you need also goes up thanks to inflation. What you need right now might be 80K, but what you need 20 years from now, 80K might not be sufficient. So again, when you plan for retirement and future expenses, do keep this in mind when you put away money in your pre-tax dollars. The other bucket of money we have is the post-tax dollars. Let's say you go invest in the stock market, or you put it in a savings account. All of that growth is taxed, obviously. And the third investment, or third bucket of pool is your tax-free dollars, like life insurance. So life insurance policies, when structured right, allow you to grow your money tax-free. So the money has to make much less percentage in your life insurance to even match up to your post-tax dollars or your pre-tax dollars, right? I mean, of course, pre-tax is also growing tax-free, but then you have to worry about taxes on the back end. The good thing about life insurance is when it's structured right, and I keep saying the structured right portion because that's really important. You don't have to pay taxes during the growth, and you don't have to pay taxes when you get cash as well. So typically you'd have, let's say, you're on the 35% bracket, you'll have about $52,000 out of your 80K to spend. You might have about 66 to 70. Again, there's some rough calculations here to spend. With life insurance, you're going to have the 100% of the dollars to spend, because tax-free growth and tax-free withdrawals up to the cost basis, and I'll explain what that is. So holistically, when you look at your wealth, you want to make sure that it's filled in these buckets in different ways. For example, you want to fill the pre-tax bucket with the dollars that maybe your employer's matching, because a lot of people are over contributing to their 401ks and somehow feeling like, okay, I saved taxes today, but you still have to think about the taxes you will end up having to pay tomorrow, and whether that's the best bucket for you to be filling right now. Or let's say your tax bracket is lower today than you anticipate maybe 5 years from now. Maybe it's better to pay those taxes and grow it tax-free in a Roth or in life insurance.
And I just want to kind of interject for 2 seconds over here. We always talk about diversification when we're investing. So these, like, I loved how you break up the buckets over there. It's like we may be able to leverage, for example, 1031 or this other vehicles to be able to defer tax, or, kind of like basically, or write off tax, like cost segregation, etc. But remember, all these are based on Congress policies. So throughout the whole decade of, not whole decade, like multiple decades of monitoring of these monetary policies, things are grandfathered in, are essentially whole life insurance, Roth IRA, the only two vehicles as far as I know, is the after-tax bucket, essentially tax-free bucket, essentially. So any policy changes, depends on election, etc., could take away all these nice juice that we have. So that's something that you should consider as well when you're kind of diversifying your tax strategies.
Yeah. And, now they're talking about taking away bonus depreciation, which we've depended on forever.
Rumors
and
has
1031.
it. Yeah.
Yeah, but I know Biden has it in his, campaign, but I hope they're saying it's very unlikely to pass. So let's just keep our fingers crossed on that one. Yeah. So this is just another view of the same thing. How safe is it? How liquid is it? What's the rate of return, and whether it's taxed or tax-free, right? So if you look at the savings account, obviously it's safe and liquid, but the rate of return is very poor, and it's taxed as well. So effectively, your 0.75% return after taxes is even lower than 0.75. When you have a 401k, it's safe. I'm trying to think. Okay. So it's not safe and liquid if you're invested in the stock market, but obviously the rate of return is high, and it's tax benefit because it's a qualified account, right? It's a retirement account. So this just compares the different investments, and life insurance is safe, liquid, got a pretty high rate of return, and it is tax-free dollars. So, and we'll cover how that with an real example on how it looks with life insurance versus these other investments. So this again was one of those images which really made sense to me about where life insurance stands, because I always frequently have investors coming in and say, hey, you know, why should I make 5 or 6% on life insurance? Why not go make 12% in the stock market? And I have to tell them that, hey, this is not an investment. It's a form of savings, right? When you're looking at investments, there's a certain inherent risk you're taking with them. And this is not that risky investment. This is not an investment that you have to worry about losing your principal, right? So a very different methodology here of investing or actually saving, and how you use that money to fund your other investments is what I wanted to kind of cover in this diagram. And when you look at your lifetime earning potential, and that's something we frequently do in life insurance, we're not looking at the person and what their net worth is right now or what their cash is right now. We're looking at the lifetime potential of the person and going, okay, what is this person going to make over the next 10, 15 years, given their earning potential today? So we need to make sure that they're insured, one, for the loss of that potential, and two, we look at that lifetime potential and we know, okay, certain part of that is going towards, you have this filter which is taking it away in terms of taxes, right? You're not allowing that lifetime potential to come through all the way, because a huge amount of that is getting taxed, especially if you're living in California and some of these other states where your state taxes are so high. You're seeing almost 40-50% of your income just go away in taxes. So I personally, this is what supports your lifestyle. I personally don't want to cut down on this, because I do believe I want to keep a certain type of lifestyle, and I'm not willing to compromise on that to make these investments and to have these savings. So the only other option is to increase your lifetime potential and reduce your taxes, right? Which is what I encourage all folks to do, which investors who come to me, it's like, hey, can you do a side gig? Can you do something else to increase your earning potential? And then can you we'll figure out how to save taxes, because now you have the same standard of living that you're maintaining, but you have this extra dollars that you can put away in your safe tank and your risk tank. And if you look at the risk tank as all the investments you're doing, and the risk tank has no lid on it, because you can have some investments go wrong. We don't have 100% of the investments go according to plan anyway, right? But your safe tank has to be a place where you can't lose your principal, right? And generally for most people, the only safe tank they have is a savings account, money market account, or something of that sort, which is FDIC insured. So today I'm here to talk about how to use life insurance account to set up that safe tank for yourself, besides having that as a tool to invest into other investments. So again, I love this tank analogy, and it makes a lot of sense to me. So I'm going to use that to show you how we use this life insurance policy to fund other investments. So normally, let's say you have a savings account and you put away your emergency savings, your property reserves, and those opportunity dollars that you want to invest into a rental house or a multifamily investment or in the stock market. Now, that's normally sitting in your savings, and when you're ready to invest, you kind of move them over to the investment. And this investment obviously has a certain amount of risk. Every investment has risk return profile. So higher the risk, higher the returns, usual, right? And when you take away those opportunity dollars from your savings, they're not earning any money for you. You take away dollars, you put it in the other tank, and then they earn money there, but those dollars are not going to do any other work for you. So let's say I'm buying a rental house and I have a bank loan for the loan to value, right? A bank loan for like 75, 80%, whatever the loan to value might be. Now, normally you'd empty this savings account, right? And you'd put a down payment for your house. So that's usual. But now this empty tank is not earning anything here, and it's just going towards a down payment. Your cash is now locked up in the house until maybe you refinance or you sell the house. So that's just the normal way of doing it. With life insurance instead, what we do is, imagine this were life insurance now instead of savings account. So instead of emptying this tank, we're going to have to use this tank to still earn money for you. It's still going to be here, that's collateral. And life insurance policy or life insurance company continues to pay you money on this savings here, while you take a loan from the company and the money comes from their company, not from your account, right? So your money is still compounding within your life insurance policy while you take a loan from the insurance company with your account as a collateral. So now you're using a borrowed down payment in addition to a borrowed bank loan. And why is this good? And we'll talk about that in a second. So I'll take a pause here and see if there are any questions. Mark asks, is it more efficient to set up a policy as a personal plan or a business plan? You can set up multiple policies, one as a personal policy. I mean, both of it insures you, let's say, or your kids or your spouse. It doesn't really matter. But you can set up multiple policies. There's nothing blocking you from either one. With a business plan, let's say you set up for your business, then you can put your business reserves away in that as well. So there's no really, your business is not insured. You're still the person insured. You're the key personnel in the business who would be insured. So it doesn't really matter either way. The insurance is on you or some key employee of the business. And you can take life insurance policies on multiple key employees, and you can continue to fund them and groom them as long as those employees, even when the employee leaves, you can still have a policy on them if they were a part of your company when you set them up. So any other questions there?
Yeah, so I actually had no idea that this is where Elisa asked her prolonged questions. Basically, I actually had no idea you can set up a policy for your LLC as well as you personally. So definitely would love to kind of, I know this is probably a 200 level session, definitely would love to kind of get into that a little bit more in deep, and that would be like some sort of our member exclusive content. But just basic question that we have was like, you can set one up for your LLC as well. Like, so this LLC, what type of, structure, company structure is allowed? The like S Corp, C Corp, sole proprietary, obviously. Like all of them are allowed?
So it's not really a business policy in the sense that you're not setting up for the business, you're setting up for a key employee of the business. And in this case, it might just be you. It might be your partner, right? So let's say I'm going to do a multifamily syndication and I have a very key partner there that, let's say something happens to the partner, I might be in hot soup. You might want to set up a policy against each other and say if something happens to the other person, and you can also use those policies to put your business reserves away. Instead of, you have now a higher place for those business reserves instead of putting it in a savings account and making 1%, right? And if something does happen to the person, now you have a life insurance policy to back up that person and their interest in the apartment, and it's extra dollars.
That's awesome. Yeah, definitely would love to chat more on that. We do have another question from Chris. And by the way, if you have a question, just put in Q&A on spots where we stop. We're going to answer them. What's the typical timeline to pay back the loan?
Right. So they are actually unstructured loans. They never really need to be paid back, but you want to pay them back. And I'll talk about why you want to pay back. From a life insurance policy perspective, you never need to pay back your loans.
Perfect. Well, looking forward to the remaining of the content here to talk about that.
Yeah. All right. So I want to talk about this again from a point of view of why you want to pay it back also, but more so in terms of exploiting the power of compounding. Before I got into this, I always looked at Dave Ramsey and who said, hey, invest, buy term and invest the difference policy, right? And Dave Ramsey has done some amazing work for people who are in debt, right, to get out of debt, because the power of compounding or the negative power of compounding works against you when you have credit card debt. And we all, I think most of us here don't have to worry about that because obviously you're investors. But people who get killed with credit card debt basically are not able to keep up because of the power of compounding working against them, right? The interest and everything that racks up is so much that they're never able to ever pay off the principal, and they're just basically paying off the interest, barely paying off the interest. And normally when you look at a savings account, what people do is save, and then they pay cash and buy a rental property, or they pay cash and buy a car. So either ways, the pattern follows this whole save, spend, save, spend. And that spending might be spending for a car or spending on a rental property. I'm not saying the two are alike. I mean, obviously one is an asset and one is not. But regardless, you empty your savings account at this point. When you do that, you're actually interrupting the compounding effect of the policy or the savings account in this case. Even though the interest rate is low on the savings policy, it can still compound over a period of time, and we don't allow for that compounding to happen because of the pattern in which we use the savings, right? So when you look at exploiting the power of compounding in the positive way, like in the not as debt but as a compounding cash, then basically what we do is save, spend. And if that spending or the removing the cash doesn't go out of your account, it allows you to compound so much faster, right? So we want to exploit the power of compounding for us by using that compounding effect within a policy, because the money never leaves our account. And that's kind of the compounding that we want to see. So this is another way of seeing the same thing, and I thought this was really powerful. Let's say you save $1,000 a month for the next 30 years. This is what it's going to look like. The green bars represented uninterrupted compounding. They represent uninterrupted compounding. It's going to be $1 million. Just $1,000 a month, $12,000 a year is going to be $1 million. I forget what the rate of interest here is, but both of them are assuming the same rate of interest, this interrupted compounding and uninterrupted. And what the disadvantage of interrupted compounding, as you can see here with the red bars or the orange bars, is that you save, and then deplete it, and then again start saving. So it never really gets up to the point of actually compounding. The compounding effect is never working in your favor here. Whereas with, let's say you had the same dollar amount in a life insurance policy, paying the same percentage as this interrupted compounding, this is what the curve would look like for your compounding for your money at the end of 30 years. And that's what we're trying to achieve in the life insurance policy, because we still go in here, let's say at this point, and we borrow from the policy, but we don't deplete the policy like a savings account, right? We still have money inside the policy and it continues to compound. And that's really the power of compounding working here for us. So this was another one which kind of got me, and I was looking at this for a while. I'm like, okay, this doesn't make sense. How does this work? But it does make sense when I explain this to you, where people say, hey, if the insurance company is charging me 5% interest for a loan against the policy, and I'm earning, let's say 5% there, it's 6 in this example, but typically right now we're seeing around a 5, just to give you an idea. So we just run with this number of 6 right now. And let's say I have a 6% interest on my insurance policy and I put in $50,000, right? No more deposits, just a one-time $50,000. In 25 years, this is what my curve will look like for that $50,000 that I put in at 6% interest. So I'm going to make a total interest of 164, and my final balance is going to be obviously 164 plus that $50,000, which is 214. So essentially I earned an interest of 164. On the flip side, let's say I borrowed against this policy and I borrowed the same $50,000 out. Remember, when you borrow, the money never leaves your account in a policy. But now I started borrowing it. I borrowed it, used it, let's say, for an investment property, which was cash flowing. And I took the money from there and I paid it back to the insurance policy. And this is why you want to pay it back, because if you don't pay it back, let's assume this was 0. this curve would actually just be flipped here, right? Because your interest would accumulate over a period of time because you're not paying it back. So essentially you would negate what you're earning here. But because you're using it in such a way that you're paying back a certain amount every month or every year, however you want to structure it, again, it's an unstructured loan. You can choose it as you want it. If you want to pay every 3 years, that's fine too, but for the 3-year period, it's going to accumulate interest, right? You don't want that interest accumulation to work against you. You want it to work for you. So my recommendation is when you borrow, instead of saving money into your savings account, you pay back the loan against the insurance policy, because that money is not accruing interest for you, but the insurance policy continues to grow for you. So this assumes you pay back 322, and I just use a regular, run-of-the-mill interest calculator. Like if you borrowed interest money for a mortgage or something, this is how much you would pay back at 6% interest. You can do a 5% and run the numbers, and the interest paid over the lifetime of this loan is only going to be 46,000. Whereas the interest earned in the account at the same interest rate, because of the compounding effect, is going to be 164. Any questions here? And this really is the gist of how we use life insurance for investments. We take a loan, we go invest with the loan, and then hopefully our money makes more than what we're paying for the loan, right? And then we return that loan over a period of time. From, let's say I go make an apartment investment on 10% or 15%. Now I'm going to return that interest back in 5 years and then pay back the loan. And then meanwhile, my policy continues to grow inside it without the money ever leaving the policy. So if there are no questions, I'll keep moving on.
I'm not sure if you're going to cover some scenario later on. So like this just got my head thinking. And by the way, thanks for explaining it so clearly, because I've been to many of these sessions, and then the whole cash value versus like the account premium just kind of confuses me. My question over here is, so let's say realistically, taking a scenario, I am putting 50K down on a single family housing. And I am earning about, like at first when you're doing value add, let's not kid ourselves. When you do value adds, there's barely any money kind of goes back here because we put the money back into the property, right? To do the improvements and etc. So for first 6 to 12, even 18 months, and maybe it wouldn't be like super profitable or even hitting 6% return. So in this case, I would be essentially having a little bit negative, right? Like if I'm thinking about that, if my investment during these years for cash flow return is not making that, so I could potentially be in an inversion scenario. Is that like correct to kind of think about that?
So I would say maybe the gap between the interest paid and the interest earned would be less in that case, because you are accumulating a lot of interest, but it still wouldn't be zero. I mean, it wouldn't still be equal as long as you paid back after 2 years or whatever. See, the longer you let this grow and not let this accumulate, the better off you are. Basically, you don't want to take a loan and never pay it back, unless there's only one case I would advise that, is that you're using it for retirement income. I'm not going to pay back retirement income. I'm done. I'm pulling out money from the policy and let it just grow. Like the interest grows, it grows. It doesn't matter, because the policy at that point becomes so efficient that it's going to basically negate any interest that accrues on the policy.
Gotcha.
So essentially, the growth of the policy will be so high at that point is that any interest that they're charging will be zeroed out. So it's essentially, if it's not a wash, it will be actually more positive than it's a wash.
Yeah. I think Mark was along the same question that I have, because oftentimes in real estate cycle, it's kind of like, hey, we're gonna like accumulate, and then we go buy a property. And then when we buy a property, for passive investors, ideally just sit around and get some cash flow. Now, market's pretty tight right now, so getting a 5 cap property or whatnot is going to be even harder to get 6 cap, right? So as such, when you get that paid back, even if you buy it in cash, your return on cash will be like 5 or 6%. So then I use that to basically fund this policy. It kind of like, it's a little tricky with like how many percentage I'm going to be able to get. Now the big event comes in real estate at the one point where you're selling the property, or when you're doing a 1031 is a moot point because you don't get any money back. It's just kind of like this unseen money, this pot just grows tremendously, but you have
Right.
like no access to it. So from there, maybe at the time of 1031, now you're able to make, some examples that we made, like quadruple through two 1031s. Then the cash value of that based on cash returns, even though it's 5% return, it's not going to be a 10% or so because now your base has grown through 1031. So then at that point, it start flipping the coin. So these are going to be very interesting, especially for real estate investor, to see how that strategy will work. Especially when you get the lump sum, you tend to buy another property versus try to pay back the policy. So just a question is like your thoughts on like how we actually would kind of execute that scenario.
So I'd say I would pay back the loan, and then yes, assuming that you have made more that much money in the investment, you could pay back the loan and then do the next investment with the remaining dollars, right? Just depends on we could take an example and work out the numbers, but generally this strategy works when, let's say, you have a 30-year mortgage on a property and you're doing a 30-year, basically an unstructured mortgage with the insurance company, and you're paying them off. Hopefully your property cash flows to 100 a month, 300 a month, something, and you just pay it off slowly. So that strategy works really well with this. When it's unstructured, like when you are not able to pay it back, then we'll have to kind of evaluate and see, okay, in 2 years, let's say I'm not going to make any payments towards this loan, how much interest is going to accumulate, right? Versus how much interest is going to accumulate in my insurance. If the insurance interest outweighs it'll at least zero it out, right? It won't be more, because your insurance policy typically makes 5 to 6% within the policy, because there's a guaranteed portion and a non-guaranteed portion, which is the dividends. Now, will that outweigh a 5% interest alone from the insurance? Probably. It'll usually outweigh it over a period of time.
Gotcha.
So,
great. Thank you.
Of course. So the way I look at it, a lot of people have exposed to Robert Kiyosaki and how he talks about doodads, right? People can use this policy to buy this doodads as well, or you can fund college. People set this up for college savings, because let's say you have a 529 plan for your child and they're still young. Yes, that's one way of saving, but we find that insurance policies can also be a very great way of saving, because it's tax-free growth, and then you can withdraw against the policy or take loans against the policy, which loan is what we recommend. Take loan against the policy and then fund the college. If you want to pay back the loan, that's fine, you can. If you don't have to pay back the loan again, it's your dollars to use. When you don't pay back the loan, the interest does accumulate, but I don't think, from the illustrations I've seen, it ever goes to negative, right? Like it doesn't start eating into your policy, because your policy is still earning money. You can also, take loans to fund your vacations. Of course, you don't want to do that. You want to make sure that you pay back. On the right side, I talk about more the investments. You have a house, you are investing in an apartment deal, or you're doing some kind of tier 4 investment. Regardless of that, you want to make sure that, okay, when it's cash flowing, you pay this back, because eventually you want to minimize your interest on those loans and maximize the growth potential of your account. And we call it a wealth maximization account. The company that I work for is called Paradigm Life, and you're welcome to look that up. And they have this term called wealth maximization account, which is where it comes from. So I want to take this example, and I think there's a question here. So the death benefit will be reduced. This is an interesting question, because usually, let's say I start with $1 million policy and I put a lot of cash inside the policy. Even though the face value of the policy is $1 million, the death benefit of the policy is much larger than $1 million. For example, I set up my policy for $1 million, but my death benefit over a period of time, like if I look at it, will be 2.8 million. So if I end up reducing the death benefit because of the loans a little bit, I don't look at it as a big ding into my death benefit, because my heirs or the next generation, they still get a pretty sizable death benefit in spite of me taking loans for my entire retirement, which is 20 years of retirement. I'm taking loans and withdrawing from the policy. So the death benefit, I think at the end of it was like 1.8 million, which is fine with me. So it depends on how your policy is structured, how much you want to contribute to it, how much you want to take from it. That basically determines what your end death benefit is at the end of your lifetime or whenever something goes wrong with you. All right, I think those are all the questions. So I want to talk about the different strategies that you can use to invest and how life insurance kind of combines and why we believe that it's a very good form of savings. And again, I'll always say that I can compare this to an investment, but it's not an investment. It's a safe tank, right? It's a savings account. So I have I need to go back here. I have a male, 40 years in this assumption. And why the age and the gender matters is that the life insurance policy, the big factors affecting the cost of insurance is the age of the person being insured, the health condition of the person being insured, as well as male or female. Because women live much longer, their policies generally cost less. And they perform better than the equal, like usually about a 40-year-old male is equivalent to a 45-year-old female. So a 40-year-old female is equivalent to a policy performance of a 35-year-old male. So usually we find like about a 5-year age gap between male and female. Sometimes I have investors just set up policy in their, like a male investor set up a policy in their wife's name because for their kids' college saving, because that makes more sense from a yield perspective because her policy performs better than his. So something to play around. This assumes 20K a contribution a year. Again, don't think about it as cost of insurance because not all of that 20K is going towards insurance. A big chunk of it is actually going towards what we call paid up additions or cash value of the policy. We also design min and max where we say, okay, out of the 20K, maybe you just have to contribute 7K a year or 6K a year minimum on a linear if your business is not doing well or you decide not to contribute, and the maximum you can contribute is 20K. And that maximum is decided by IRS. In 1986, IRS came and suddenly discovered, oh my God, we've been leaving a bunch of money sitting in life insurance policies. All these wealthy people are maxing out their policies and dumping a bunch of cash. So they decided to make life insurance policies taxable after a certain limit. And there comes in what we call a MEC or modified endowment contract. So if we design the policies so that they don't MEC, which means they don't become taxable, we design those policies not to be taxable based on the death benefit and the contributions. So given a specific death benefit and male of, let's say a male of 40 years, the amount of money you can put in the policy is limited, right? Based on the death benefit. So if you increase the death benefit, you can contribute more into it. And those contributions are determined by IRS, and they say, okay, this is the max you can contribute. So this assumes, I believe it's a 24-year contribution, not 30-year contribution. And we're looking at the returns at the end of 30 years. We assume a 35% tax rate. And insurance returns, as I mentioned, we have a guaranteed return and we have dividend returns on top of the guaranteed. So this is a policy projection for the 40-year-old male. We have something called the base contract premium, which is the base policy premium. And then we have FPR. I don't want to get into these two right now because will be the level 2 one. I'll get into that a little bit more. But what's important to take away here is that the total premium I paid was $20,000, right? A big portion of that, this is heavily a cash value. This also heavily goes towards cash value. The only thing which is not going towards cash value in the first couple of years is this portion here, which is the base, right? So if you look at the cash value here, you have 13,000 of the 20,000 accessible the first year. The second year it goes up to 27 and third year 48. So let's say in year 5 I've contributed $100,000. I'm looking at 94,000 accessible. By year 6 I have way more. I have all 100% of what I put in accessible. So the reason we don't see 100% accessible the first few years is because the insurance company is trying to recover the cost of setting up your policy, paying commissions, all of that stuff. But what they do is they take your dollar, they invest it, and now over a period of time, we call it the seasoning of a policy, more and more of your dollar becomes accessible. So let's say as a 6-year policy term, we have 120K, that's all of the money we put in. Which is 100% accessible as cash value for you. So over time, this bank becomes more and more efficient. And let me point out, let's say year 10, we have contributed $200,000. Now you can see there's 239 there. Plus the increase in cash value for that $20,000 input is now $32,000. So you are basically making that $12,000 in dividends and other in growth of the policy. So as you ideally year 6-7 is when policies become very efficient. So you don't want to take a policy and just lapse it or not use it well, because this is where it functions well as a bank. And the structure of a bank is every dollar I put into a bank is a dollar I can take out. And if you look here at this point, a dollar you put in is a dollar you take out, right? In cash value. That's what we're looking for. So it takes time to season that bank. And initially, I always tell investors, you might have 75% of what you put in accessible in the first year, 80% the second year, and so on and so forth. The younger you are, the more money will be accessible sooner because your cost of insurance is low. And another thing we do here is if you compare this to a regular whole life policy, this premium will be much lower for this death benefit of 1.1 million, 1.2 million almost, is much lower than any regular whole life insurance. And I'll talk about why that is in a few minutes. But this is kind of like the gist of it, of how this policy kind of matures over time. So if I were looking at an insurance accumulation, for 20K every year until age 64, a 40-year-old male started contributing for 24 years, his cash accumulation value would be 1.348 million at the end of 30 years. So he contributed till age 64 and stopped. By age 70, it's going to be 1.348 million. And the IRR doesn't look very impressive. It's okay, right? Like you could do multifamily investments at 15 IRR in a short term, right? But I think what's important to see here is to compare, if I were to do the same value, same amount, dollar amount in a savings account and get taxed at 35%, I would need to make 8.26% to just match it every single year for 30 years. Every single year for 30 years, your savings account would need to return 8.26%. Because again, we're comparing this to savings, not to an investment, right? Because this has no risks. I mean, we're not taking any amount of risk here, putting it in a life insurance account. So I don't know of any savings account which has returned this, let alone 0.8% over 30 years. So this is a comparison of an investment account. Again, I don't think it's a fair comparison because there's risk when you invest, right? Like the market can go down, up, and this assumes a 1.7% management fee, which is typical in most mutual funds or managed investment scenarios. The rate needed to match in equivalent because of taxes will be 10.14. And again, the account has to make 10.14% every single year for 30 years, which we know is not possible in the stock market because we have some lean years and some not so good years as well. So just to summarize, an insurance policy, a tax rate is 0, management fee over time is very, very low. It's under 1%, and we'll talk about that. Your rate of return is 5.37, let's say, IRR. Your savings account will need to make 8.26 IRR to match that investment. And your managed investment would need to make 10.14 every single year to match this investment. Questions? I see a lot of questions here.
Yeah, we have lots of questions. I'm going to read them. How do you make money in this model?
You are making money in the policy. That's it. And then you take the money from the policy, take the loan from the policy and go invest in whatever you want. So let's say you had $50,000 in your savings account. You take that and make an investment normally. Instead of doing that, move that $50,000 to an insurance policy, take a loan against it. Maybe the first few years, you might not have 100% of that 50,000, but you'll have a big chunk. Now go make that investment with that loan. Your policy is still growing that money within the policy. So that's kind of how you make money.
Right.
Does it make sense to set up policies in your kid's name? Yes and no. Okay, you can't push a lot of money into kids' policies, but you can set them up with policies that they can use for their lifetime, which is a great way. Like I know a lot of investors, like I can't personally set up for my daughter. She has some major health conditions, so it doesn't make sense for me to set it up for her. I tried, I did, but if you have a healthy kids, does it make sense? Absolutely. You push bunches of money? You can't. Unfortunately, kids policies are, I mean, you can set up a death benefit to be really high, but because of their age, they don't allow them to push as much money into the policy. But that said, it's a great tool for you to get started with savings. Instead of a savings account for them, I would do a policy all day long, because it's going to compound and grow over a period of time. They can take a loan against it for their college if they need to. They can learn to use it for their own investments later on. And you just started them and seasoned the policy really, really well right now. And it's just going to be super efficient by the time they get older.
So compare this versus a Roth IRA, let's say. Which one should I be then funding at the priority? Do I do Roth IRA first until that bucket's full per year and then starting doing the whole life?
Sure. I mean, again, it depends on what are you investing
For
your Roth
kids.
into, right? Like,
For
let's
kids,
say,
sorry. For the
right,
kids.
right. No,
Yeah.
I understood. I understood what you said. I thought about the same thing for my daughter. That's why I kind of got it. It depends. So what is your Roth IRA being invested in? How much is it earning? If you have an efficient place to invest your Roth that can earn 10% in the market, sure, invest your Roth first, right? I mean, a Roth, I think, is always a good thing. Push as much money as you can in your Roth, but then Roth has a very small limit, right? 6K, which is nothing. So I think it's better to do both if you can afford to do both. Set up a policy, do half to Roth, maybe 12K that you can pay to your kids without taxes now. You can do half to Roth and do the half to insurance.
Gotcha. So actually, just to correct, I think we'll leave Chris's question to last on this one, which is how Kavitha, a policy setter in this model gets paid. So he actually meant like, how does Kavitha gets paid if she was used?
Oh, is
for
that the
my
question?
Yeah, that was the question.
I think I didn't
The
understand.
compensation model.
Oh, I'll tell you. I get paid through the insurance company, because what they do is, that's what you see in the first year. You saw that you put in 20,000 and they only have 13,000. The insurance company uses that initially to actually cover their costs in setting up the policies, including commissions for other folks, all of that stuff, right? But over a period of time, the insurance company invests your money and makes up the difference, because they are basically putting your money to work outside. They do corporate bonds. They do a lot of safe collateralized investments. They are not playing in the risky market like us. So basically they cover all the cost of commissions and the cost of their overhead, right? Like their company's overhead. The first couple of years is how they cover it. And that's why you don't see 100% of your money in cash value, because they're using your money to pay for all of those things. Will you be paying for that in the future? No. Over a period of time, all that catch up, like I showed year 6, all your cash value is in there.
And then, so you as a policy setter, because the insurance company is like the end product, essentially, you would then getting paid per commission. I guess what I'm trying to get to is there are whole life insurance out there. I've personally visited financial advisors who's try to sell me whole life insurance, but when I looked at policy setup, it's not the type that I wanted, because they're usually high on commission or high on premium, but low on cash value. So in that way, the policy setters, they get paid per commission, and they actually gets paid quite a bit. So they're making money for themselves, not me. But in the case where Kavitha, like you probably make very little on that, because the premium, I think it's the compensation is hinged on in terms of commission versus the cash value.
Correct.
But,
so what's happened is, and I'll talk about that, about how we structure the policy. So actually, it is more beneficial for me not to do high cash value, because my compensation is based on the base premium. But what I do for my investors is reduce the base premium to the minimal amount and maximize the cash value portion to the maximum amount. And that means that my commission gets reduced because the base premium goes down so much.
Mm-hmm.
Right? So we actually get compensated. It's kind of counterintuitive. And I think that's probably why a lot of insurance folks don't want to do high cash value, because
Yep.
they get paid less with high cash value policies than they do with regular policies.
Yeah. So
I'll
for
talk.
Kavitha, and I can kind of share because me and her are a long-term friend, it's okay to share the incentives over here, is her main business isn't doing insurance. And that's the key over here, because she is actually doing syndication, and she's doing, you know, real estate, like being an agent, etc. So this is almost a loss leader for her in terms of like helping investors kind of get the best out of their money invested. Right, which is why oftentimes you don't find these on the main street or the regular essentially policy setters for whole life insurance. So that's kind of how it's getting compensated. I want to get into other questions. Mark has a question: would it be more efficient not to take a loan in the early year of a policy, or would it make a difference? So should it be like, I just don't take any money out? Like if I have 50K set aside, because we all have buckets of investments, right? Once you have multiple of them, ideally you're not putting all the eggs in the one basket. So if I'm always have 50K, I calculated 50K to 100K, that just money sitting around for emergency, like it's my buffer money. That I probably shouldn't touch. But let's say I have another 100K that just kind of sits around. So then does it make sense for me to just kind of fund it, and then up to a point where it reaches that balance point, and then I start taking the money out?
You don't have to wait till that long to take the money out. As long as you're not draining, let's say the first year, I have the 20,000 example, right? I'm not draining the policy like 13,000, because the minute I drain the policy fully, it's not become efficient yet. You kind of want to get to the point of growing well initially the first few years. So let's say I put away, I have $50,000 usually for my emergency fund. Let's say I put that away, and then every year I contribute 30,000. I'm just giving an example. So my emergency reserves never leave that account, right? It just keeps growing. But I do have some play money that is my opportunity dollars that goes in and out of that account. And that's okay to take a loan, as long as you don't deplete the policy 100%. And it's okay to deplete it too. Technically, the insurance company says you can put in the money today, 3 days later, they'll send an ACH transfer for the cash value as a loan. But the question is, do you want to accumulate the interest? Unless you're doing something else with that money, I wouldn't just take it out for the heck of it, right? Leave it there as long as possible. Let it accrue, let it accumulate, let it compound. It's still going to compound if you take a loan, but you'll have a loan with the insurance company needlessly, unless you're going to go make another higher yield investment. So I'm not going to take out the money for a lower yield investment, but if something makes me more than 8% taxable, maybe it's a good time to, good to take a loan out and go do that investment.
Definitely. And last question: does it work for a person close to retirement?
It can, for sure, but you can't like fund it, let's say today, and then 3 years later start draining it for retirement, because again, you want to accumulate and put at least 5 to 7 years worth of money into it before you start draining it, because you can't just fund it and take it out and expect it to perform like if you were funding it for 6 or 7 years.
Yeah.
So I tell people, either do a one pay, like a huge fund at once and take it out slowly, or you do fund over a period of time, like 7 to 10 years, and then go to, ideally you want to be at least 30s, 40s younger, because then you have some time for the policy to really accumulate and compound, and then it becomes a huge source of retirement for you.
Gotcha. Great.
Cool. All right. So this is another question that a lot of people ask me, so I thought I should cover it. How safe is insurance? So just to give you an idea, FDIC insurance covers about 7% reserves, which means FDIC has about 7% of the amount they insure right now. So if it's $1 billion, so they only carry 7% of that in reserves. So essentially what the government is banking on is if they run out of, if they have to pay more than that, they have to print money. Essentially, they don't really carry that kind of assets. Life insurance, on the other hand, actually it's a dollar for dollar. So they cannot leverage, and they have to cover dollar for dollar. And if you're familiar with fractional reserve banking system, where basically a life insurance, a bank can take $1 and lend it to, 9 different people, the same dollar, right? It's a concept of fractional banking, and you can't do that with life insurance. So from my perspective, it's actually safer than an FDIC insured account. Um, Not to mention that most corporates, actually banks and corporate companies, have huge life insurance policies that they carry with their money. So Bank of America, for example, has $21 billion in bank-owned life insurance. That's what it's called, BOLI. Is bank-owned life insurance. So they cover 30 to 35% of the executives with this bank-owned life insurance. So that's how heavily banks are actually invested in life insurance assets.
Mm-hmm.
For example, a policy, I just want to talk about Penn Mutual. Penn Mutual is one of the companies I work with a lot lately because their policy is extremely, very efficient. When I talk about efficiency, I mean, I get my dollar much sooner, dollar for dollar, and the growth of the policy is very good. They have been around since 1847. Right? They guarantee a certain amount of interest on the account plus a dividend that they share because they're a mutual company. What is a mutual company is basically like a credit union. The employees or the stockholders or the investors or the life insurance policy holders in this case are actually a part of the company, and so they distribute their earnings after all their profits rather after all the expenses to the mutual company holders. So you, as let's say you get a Penn policy, you become eligible to get dividends from them, and dividends are nothing but the profits of the company that are split. And just to give you an idea, Penn has paid dividends and the guaranteed portion through Great Depression. So that's how strong these companies have been. They're not like someone who they just don't blow up, unless you go for a weak company. We do policies with very strong companies that have been around for 150 years or more and have survived through multiple, depression, Great Recession, and all of that stuff. The other
The
thing,
only downside, right, Kavitha, is basically, yes, there's all these tax benefits to this, is the fact that it's still privately owned. These companies are privately owned. So,
yes.
so basically the one thing that's why we want to research and use a very good insurance company that has been there for many, many years through recessions, because it is still privately owned entity. Yeah.
Yep, absolutely. We don't usually do business otherwise with companies which haven't been around for a long time, which haven't proven themselves. Also, I also want to point out this idea of state guarantee fund. So every insurance company for every policy has to contribute a certain amount of dollar from the policy towards this guarantee fund. It's kind of like basically saying if the insurance company goes out of business, bankrupts for some reason, that they insure every person going through that insurance company they reimburse through the state guarantee fund. I mean, there's obviously limits to that. I think Texas, for example, has like 350K or something limit, and then double that, like 700K in death benefit limit on the state guarantee fund side. But that's very, very unusual, right? Like even if life insurance companies go out of business, a bigger one comes and captures them. Basically, they get acquired. So that's usually not an issue that we've ever had to deal with.
Yeah. So I just want to give everybody a heads up. We're at the end of the session, right? And we do have some more follow-ups over here. We do have another session with 200 level sessions, but that will be for EasyFI members only. So you can definitely, if you're a member, you can definitely catch up with Kavitha in these sessions, ask more of your questions. And then we're going to stay a few minutes longer to kind of wrap up the session over here. Just want to make sure I'm conscious of everybody's time. Yeah.
So do you want to go through the questions, Elisa? Because
Yeah.
I mean, there's more I can cover, but we can do it in another session as well.
Yeah. So I think, well, I just kind of assumed that was kind of more wrapped up, but
I have a couple more, but yeah, the gist of it is, I mean, I'll maybe this is a 200 level session. We'll talk about how this is structured versus a regular policy. This is regular policy. This is how we structure it. We make the base really small. But again, I can get into the details of how we make that happen and how we focus on cash value and not on just on the death benefit. So please do watch out for the level 200 session, and then we'll cover more of these details. So just to summarize, I think this is a good summary slide. Why life insurance, why high cash value life insurance specifically. You can, have high yield. You can have, basically the account serve any need. 529 serves a college need. Life insurance policy serves any need you have. It's basically dollars. You maximize the opportunity cost because you can use the same dollar to put it into a policy and then go invest in something else. You create generational wealth, obviously, because you have that death benefit which comes with it. You have uninterrupted compounding, you have guaranteed returns plus dividends, you have a pool of money, and this is a big one, guys. The asset protection aspect. A life insurance policy is automatically asset protected. You don't have to set up any complicated asset protection strategy around it. Most judges won't even hear about anyone coming close to a policy benefit, right? They won't touch the money. Like, cash value is protected, your death benefit is obviously protected. You can also create a great source of tax-free retirement income. And again, level 200, we'll talk about that. Any questions? And I think there are some questions.
Yeah.
Let's go through those.
Yeah, so I'm going to skip Mark's question, and Kavitha, you can type in. He was asking about where your name come from. But basically, what creates the underlying stability of this asset known as life insurance? Great question.
I think that's a great question, Chris. The underlying stability basically comes from the fact that life insurance companies invest in very strong assets. For example, life insurance company might go invest in this huge plant that Coca-Cola is creating, and it's collateralized by a huge company like Coke. Right? They're not investing in stock market. They're not investing in even the bonds that we have in the stock market. They're investing in corporate bonds. They're investing in real estate. They're creating all these collateralized assets that they're investing in. So it basically creates a very strong cash flow and collateralized safe investment for them. And so also, there's a dollar for dollar. They have something called reinsurance. So they're basically protecting themselves in multiple ways. And that's what creates the stability in life insurance. Okay, the life insurance investor in real estate is a significant portion of their own portfolios. I wouldn't say it's significant. I'd say it's there. You can actually go to Penn Mutual. I suggest you do that. Penn Mutual, just Google Penn Mutual. You'll go to About and actually look at the investment profile. You can see what the breakdown is. They have a pie chart and they tell you what they invest in. And I would highly recommend that. All right, what is the current dividend? The dividends varies each year, Mark. It's usually like 2% or so. Depends on how, and obviously this year might be lower. None of the assets are probably returning from the real estate perspective, right? I know we're having that issue. So, but what's interesting is if you look at a strong company like Penn, they haven't not paid dividends for 30 years, 40 years, hundreds of years, right? So they have a pretty strong dividend payment history. And let's say the dividends dropped in a couple of years. I remember this illustration with Penn, and the dividends were below what was projected only for 2 out of the last 20 years. So it was a little lower than what they projected, but generally they pay very strong dividends that basically works up to around a 5.5, 5.4 IRR. Now you look at a male's policy and a female's policy, that IRR might look lower for a male's policy actually because of the cost of insurance being higher. So all of those factors in as well, but generally the dividend is the same, but the cost of insurance eats away from that whole accumulation in your account. So that's really what determines your IRR at the end of the day. I think I got through all the questions.
Yes. Last question that Mark had, which is a great segue. We look forward to bring you more of these free webinar investment related topics to our free webinar list. So make sure that you enrolled in there, and if you register here, you will be automatically added to it. And Kavitha will be coming back in 2 weeks, talk about a more 200 level sessions that dig into this a little bit more, and then providing exclusive Q&A sessions for our members only at EasyFI University. So that will be a paid members only. So if you're a member, you will have access to this. I know a few our member has logged in on this. So we'll be doing a continuation of this, and also dig into a few scenarios specifically how someone can kind of leverage this. I know I have many questions for that. So really looking forward to that. Thank
Absolutely.
you, Kavitha, for your time. And I think you can also contact her for more information around the policies, to essentially get a one-on-one 30 minutes consultation with her as well.
Yep. Of course. Thanks, Elisa, for having me on. Guys, thanks for having me on. I hope this was useful and gave you a good idea of how this works. Again, if there are any specific questions, feel free to reach out to me. And also, we'll do the 200 session, level 200 session, as Elisa mentioned, in 2 weeks from now.
Yeah. Thank you so much.
Awesome. Thanks, Elisa. Thanks, guys. Bye.
Bye.
Thanks, Mark.